Now speaking, Catherine Miller, Senior Vice President, Investor Relations. Good morning everyone and thank you for joining us for our quarterly earnings conference call. We have provided a presentation on our website, synchronyfinancial.com, which covers the topics we plan to address during our call. Our comments today will include forward-looking statements which are subject to risks and uncertainty, and actual results could differ materially. During the call, we will refer to non-GAAP financial measures in discussing the company's performance. On the call this morning are Brian Doubles, Synchrony's President and Chief Executive Officer, and Brian Wenzel, Executive Vice President and Chief Financial Officer. We will be discussing our financial performance for the quarter, including our net income of $1.2 billion, an increase of 8% year-over-year. We will also discuss our total revenue of $4.7 billion, an increase of 7% year-over-year. Additionally, we will discuss our return on equity of 17.3%, an increase of 1.2% year-over-year. Finally, we will discuss our new initiatives and major announcements. Now speaking, Brian Doubles, President and Chief Executive Officer. Good morning everyone. Synchrony delivered strong financial results in the second quarter, including net earnings of $569 million or $1.32 per diluted share, a return on average assets of 2.1%, and a return on tangible common equity of 21.7%. We opened 5.9 million new accounts and grew average active accounts by 7% on a core basis, setting a new record with $47 billion in purchase volume. Health and wellness purchase volume grew 17%, digital purchase volume increased 8%, diversified value purchase volume increased 7%, and lifestyle purchase volume increased 10%. Dual and co-branded cards accounted for 41% of total purchase volume and increased 14%. Consumer behavior is reverting to pre-pandemic norms, and our products and value propositions are resonating strongly across our diversified set of platforms and partners. Our view into the consumer shows continued normalization in consumer behavior toward pre-pandemic levels. Average transaction frequency continued to grow in the quarter, while average transaction values declined modestly. Payment rates increased sequentially due to tax refunds, but year-over-year, payment rates continued to decline across age and credit bands. The external deposit data we track shows that the average consumer savings balances declined approximately 2% from the first quarter but remain approximately 7% above 2020's average level. We are advancing our key strategic priorities of our business to position Synchrony for long-term success, including the expansion of our multi-product strategy across partners, distribution channels, and markets. We are leveraging our data and advanced analytics for our digital ecosystem to deliver fast, seamless offers designed to responsibly support each customer's particular purchase. Our buy now, pay later solutions have become popular options and are successfully attracting new accounts and driving deeper engagement. We are excited to further roll out these offerings across more programs and through our proprietary distribution channels over the coming months. As Synchrony continues to broaden our product suite and empower these offerings with our dynamic decisioning capabilities, we are better able to acquire and deepen relationships with our customers. We see these new installment products leading to cross-selling opportunities and product upgrades across the business and helping partners build lifelong customers. As we head into the second half of 2023, Synchrony is well positioned to capitalize on these and other new opportunities while continuing to consistently deliver for our customers, our partners, and our shareholders. Now speaking, Brian Wenzel, Executive Vice President, Chief Financial Officer. Synchrony's second quarter results demonstrate the power of its differentiated model. Purchase volume was driven by its broad reach across industries and verticals, as well as its compelling value propositions. Core earnings receivables grew 15% year-over-year, driven by a 130 basis points decrease in payment rate and 6% growth in core purchase volume. Net interest income increased 8% to $4.1 billion, reflecting 19% growth in interest and fees from higher loan receivables and stronger loan receivable yield. The net interest margin of 14.94% declined 66 basis points due to higher funding costs, partially offset by higher loan receivable yields and higher liquidity portfolio yield. Provision for credit losses increased to $1.4 billion, reflecting higher net charge-offs and a $287 million reserve build. Other expenses increased 8% to $1.2 billion, primarily driven by growth-related items, as well as operational losses and technology investments. Synchrony generated second quarter net earnings of $569 million or $1.32 per diluted share, a return on average assets of 2.1% and a return on tangible common equity of 21.7%. Credit trends continued to normalize toward pre-pandemic performance, with 30-plus delinquency rate at 3.84% and 90-plus delinquency rate at 1.77%. Net charge-off rate was 4.75%. Total liquidity, including undrawn credit facilities, was $19.4 billion, up $521 million from last year. CET1 ratio was 12.3%, 290 basis points lower than last year's levels of 15.2%. The Tier 1 capital ratio was 13.1% under the Kekel transition rules compared to 16.1% last year. The total capital ratio decreased 220 basis points to 15.2%. And the Tier 1 capital plus reserves ratio on a fully phased-in basis decreased to 22.4%, compared to 25% last year. Synchrony announced approval of an incremental $1 billion share repurchase authorization for June of 2024 in addition to the $300 million remaining on the prior authorization. It also announced its intention to increase the company's common stock dividend by 9% to 25 cents per share from 23 cents per share beginning in the third quarter. For 2023, Synchrony expects ending loan receivables to grow by 10% or more, payment rates to normalize but remain above pre-pandemic levels, net interest margin within a range of 15% to 15.15%, delinquencies to reach pre-pandemic levels during the second half of 2023, net charge-offs to trend toward the lower end of 4.75% to 4.90%, RSA to trend between 3.95% and 4.10%, and quarterly operating expenses to trend at approximately $1.15 billion. Now speaking, Brian Doubles, President and Chief Executive Officer. Thanks, Brian. Synchrony has a differentiated model that has enabled the company to consistently provide best-in-class experiences for customers and strong outcomes for partners, even as their needs change. This business generates strong capital which is used in an effective and prudent manner to deliver sustainable, long-term growth with attractive risk-adjusted returns. Looking ahead to the remainder of this year, the company is confident in its ability to execute on strategic priorities and deliver value to stakeholders. Now speaking, Catherine Miller, Senior Vice President, Investor Relations. Thank you for joining us today for our quarterly earnings call. We are pleased to report that our company has achieved strong financial results this quarter. Our total revenue was $1.2 billion, up 8% from the same period last year. Net income was $200 million, up 10% from the same period last year. Our gross margin was 40%. Citi analyst Aaron Saganovich inquired, what will drive the decrease in growth from 15% to 10% by year-end? Brian Wenzel replied, good morning, Aaron. We anticipate the payment rate to remain elevated compared to pre-pandemic levels, but to moderate as we move through the back end of the year. We expect to see strong purchase volume growth on a dollar basis. Last year's acceleration, beginning in the second quarter and continuing through the end of the year, provides more difficult comps. On a V basis, the asset build and payment rate came off a high last year, making for a more difficult comparison. However, we anticipate strong performance across all our sales platforms for the remainder of the year. Citi analyst Aaron Saganovich inquired, what is driving the strong growth in digital and health platforms? Brian Doubles replied, we're pleased with the growth we're seeing across all our platforms, particularly in health and wellness, up 22%, and digital, up 18%. Our investments in marketing and products in health and wellness are paying off, and our new digital programs are performing well. We anticipate continuing to outpace expectations in these two areas. Wells Fargo Securities analyst Don Fandetti inquired, could you provide an update on consumer behavior, particularly in regards to customer callants and wages/working hours? Brian Doubles replied, the consumer is still strong and spending is above 2020 levels. We just reported a record purchase volume in the second quarter. Credit is in line with our expectations, maybe a touch better, but still below 2019 and our long-term target of 5.5 to 6%. We're monitoring the situation closely and so far, everything is in line with our expectations. Credit should continue to normalize through the rest of this year and into 2021. Wells Fargo Securities analyst Don Fandetti inquired, are you expecting the allowance rate to remain steady or improve? Brian Wenzel replied, yes, Don. Our reserve provisioning in the first half of the year was growth-driven, with 285 and 286 for Q1 and Q2 respectively. We anticipate delinquency formation to be in line with our expectations and expect to return to pre-pandemic levels of delinquency in the mid-second half of 2021, as long as macroeconomic conditions remain consistent with our expectations. Bank of America Merrill Lynch analyst Mihir Bhatia inquired, what is your perspective on the CFPB late fee rules and deferred interest medical cards? Brian Doubles replied, yes, sure. Regarding late fees, we've been working on this for over a year. We're having productive conversations with our partners about different offsets. The industry is likely to see new pricing models and pricing actions across all issuers. We're discussing higher APRs, different types of fees, penalty pricing, and underwriting. We want to protect our partners and offset the impact, while continuing to underwrite customers. We expect a final rule in the fourth quarter, which may be litigated. We're as prepared as we can be and will provide updates as we learn more. What was your second question? Bank of America Merrill Lynch analyst Mihir Bhatia inquired, can you provide an update on the inquiry into deferred interest and medical cards? Brian Doubles replied, I'm proud to say that CareCredit is not a medical credit card. 70% of our business is in dental and pet care, and we strive to make our products fair and transparent. We believe our practices are industry-leading and we hope to level the playing field for other issuers. Our customers give us great feedback on this product. Bank of America Merrill Lynch analyst Mihir Bhatia inquired, what gives you confidence that delinquency rates will stabilize at pre-pandemic levels after approaching them in the next 6 months? Brian Wenzel replied, thanks, Mihir. Our pre-pandemic delinquency levels are 87% and 82% of historical levels for 30+ and 90+ respectively. This is 60 basis points lower than 2019 for 30+ and 40 basis points lower for 90+. Our current loss rate is 82% of our midpoint of our underwriting average. We're not seeing significant deterioration in our 2018 and 2019 vintages, and our 2021 and 2022 vintages are performing in line with our expectations. We've taken prudent actions to de-risk the loss rate for next year, and will provide updated guidance on the full 2024 loss rate at the end of the year. Goldman Sachs analyst Ryan Nash inquired, Brian, what is driving your updated expectations for the second half net interest margin? What betas are you assuming now that rate cuts are no longer expected? How do you see the margin trajectory over an extended period of time if rates remain higher? Brian Wenzel replied, thanks, Ryan. The betas we experienced in the first half of the year were mid-70s to low 90s for savings and CDs. In the second half, we've seen competitors increase their prices due to cash flow issues and risk mitigation strategies. We expect our betas to increase by 10 percentage points, with savings in the mid-80s and CDs around 100%. Going forward, we anticipate the market to remain rational and the betas to remain stable. We also expect tailwinds from benchmark rates pushing through the floating portion of our portfolio, revolve rate increases, and liquidity portfolio payouts. Goldman Sachs analyst Ryan Nash inquired, Brian, what impact do you anticipate potential regulatory changes will have on capital and liquidity management? Brian Wenzel replied, Vice Chair Barr has indicated that the Federal Reserve will be issuing proposed rules around capital requirements. We have been preparing for potential changes to risk-weighted assets and operating risk, but have not taken any definitive action yet. If the Fed extends long-term debt or TLIC requirements, we are in a good position as we are currently in surplus. We will closely monitor the rules and adapt our business accordingly to optimize risk-weighted assets. Piper Sandler analyst Kevin Barker inquired, do you see a shift in consumer behavior due to the extended period of high payment rates and robust loan growth? Brian Doubles replied, thanks, Kevin, for the question. Payment rates have normalized back to pre-pandemic levels for non-prime and lower credit grades. Prime and super prime customers, however, have built up excess liquidity and are still paying at a higher rate than before the pandemic. We expect these customers to eventually normalize back to pre-pandemic levels. Autopay has also increased by 4 percentage points to 20% of accounts, which helps entry rate in delinquency, but is not expected to have a material shift. Overall, we believe this is part of the recovery and exit out of the pandemic period until we get more clarity on when the excess savings accumulated during the pandemic will be depleted. Piper Sandler analyst Kevin Barker inquired, do you anticipate an impact on spending and sales volume due to the student loan restart payments in October? Brian Doubles replied, Kevin, we understand the population of people with student loans and the amount of those in forbearance and non-forbearance. Our FICO range is only 10 points different from the delinquency rate. 46% of those pre-pandemic were making payments, so we feel confident in their ability to manage their finances. We don't anticipate a decrease in purchase volume as we move into the back half of the year and early 2021. We have a tough comp from last year due to pent-up spending, but health and wellness and digital are driving the engine forward. JP Morgan Chase & Company analyst Rick Shane inquired, what is your target deposit ratio going forward in light of the events of this year? Brian Wenzel replied, thanks, Rick. We have not changed our funding targets. Our deposit franchise is strong, providing 84% of our funding. We've seen positive net flows every week, including during the bank turmoil. Our customers are sticking with us and we have a high retention rate for CDs. We also access the wholesale markets to manage betas and meet debt maturities. Our goal is to maintain 80+% of our funding stack from deposits. JP Morgan Chase & Company analyst Rick Shane inquired, Brian, what potential arbitrage opportunities exist between the wholesale and deposit markets in this rate environment? Brian Wenzel replied, Rick, access is key for us. We're not looking to arbitrage the market, but rather create a steady foundation and the right mix of funding going forward. We're confident that our performance and ability to manage the regulatory environment will lead to tighter credit spreads over time. Our goal is to protect the balance sheet and provide the necessary liquidity in all situations. Keefe, Bruyette & Woods analyst Sanjay Sakrani inquired, Brian, could you provide an update on Synchrony's position for any large portfolio RFPs or other deals? Brian Doubles replied, Sanjay, our BD pipeline is largely comprised of smaller startup opportunities that take more time to develop. We are also actively pursuing larger opportunities, but we are very disciplined in terms of risk and return. We hold the bigger deals to a higher standard of scrutiny to ensure the right balance and alignment with partners. Keefe, Bruyette & Woods analyst Sanjay Sakrani inquired, what is your operating assumption for late fee regulations and how do you plan to adjust accordingly? Brian Doubles replied, we don't agree with the proposed $8 fee as it has unintended consequences for consumers and small businesses. We are actively engaging in the comment letter process to advocate for a higher amount. We are preparing for the $8 fee to go into effect, but we are also exploring other angles to substantiate a cost higher than $8. We need to have revenue offsets in place to protect our partners and continue to underwrite their customers. We have been focused on this for the last 12 months. Evercore IC analyst John Pancari inquired, what portfolios are you seeing migration on the non-prime side and what actions are you taking in response? Brian Doubles replied, thanks, John. We can't get into specifics regarding portfolios, but if we see a credit score in the 700 range with a migration of 50 to 60 basis points into non-prime, we take immediate action. This could include reducing the exposure balance, decreasing the credit line, or closing the account. We do the same for our inactive portfolio. These are minor refinements that help de-risk next year, but are unlikely to have a material effect. Evercore IC analyst John Pancari inquired, can you provide more detail on the updated expense outlook and what drove the revision? Brian Doubles replied, we are seeing growth opportunities in our portfolio, particularly in the health and wellness and care credit segments. We have added resources to support this growth and have seen an increase in purchase volume in the first half of the year. We anticipate variable cost increases as we service more active accounts in the second half. Fraud levels have returned to more normal levels, with one incident from a partner driving up costs this quarter, but with an RSA offset. Brian Wenzel replied, I'm pleased to report that we've seen a year-over-year improvement in our efficiency ratio, indicating that we're getting operating leverage. This is a key measure for us and we remain focused on it. Morgan Stanley analyst Jeff Adelson inquired, could you please discuss the RSA sustainability at the current run rate levels compared to the 4 to 4.5% long-term guide? Does the lower 2023 NCO guide reflect increased willingness of retail partners to share higher OPEX? Brian Doubles replied, yes, Jeff. The RSA does include expenses. This has an effect on our partners and is reflected in the lower net interest margin from interest-bearing liabilities. The 4% to 4.25% we started the year with is now 3.90% to 4.15%, which is at the lower end of our long-term guide. This is due to higher net charge-offs and expenses, and the RSA is performing as expected. We have updated our guidance to 3.90% to 4.15% and believe this is a good estimate for the year. There have been no fundamental shifts in the economics shared with our partners. Morgan Stanley analyst Jeff Adelson inquired, what changes have you made to your account acquisition profile over the last 3 months? How does student loan repayment factor into your underwriting process? What feedback are you receiving from customers? Brian Doubles replied, we haven't taken any broad-based actions with regard to account acquisition. We assess performance against risk-adjusted margin and probability to default on a partner channel basis. We make small adjustments as needed, but try to remain consistent with our partners in managing exposures through line. Our new account origination has been consistent both last year and through the first half of this year. Jefferies analyst John Hecht inquired, Brian, how does the increased usage of BNPL affect overall volumes, fee structures and margins? Brian Doubles replied, I think the long-term strategy here is to offer a multi-product approach that provides choice to our partners and their customers. This model has benefits for both us and our partners, as it can be used as a customer acquisition tool. We've seen a shift in this model during the pandemic, with partners engaging in buy now pay later to drive sales and bring in new customers. We're employing a model that allows us to customize the product for each partner, balancing risk and return while making it economically attractive. Jefferies analyst John Hecht inquired, what can we expect from Q3 and Q4 NIM seasonality? Brian Wenzel replied, thanks, John, for the question. Our net interest margin should increase slightly in the third quarter due to liquidity deployed and benchmark rate increases. We expect this to flatten out in the fourth quarter, with a short-term benefit from the end of the second quarter. Oppenheimer & Company analyst Dominic Gabriel inquired, can you provide insight into the increasing debt collection fees and what it may mean for net charge-offs in the industry? Brian Doubles replied, when it comes to our product, we primarily originate it through digital channels. This has allowed us to increase sign-ups and average balances, which in turn has a positive rate impact. We are proud of the benefits we offer our consumers and strive to be transparent in our digital channels. Oppenheimer & Company analyst Dominic Gabriel inquired, could you please explain the incremental expenses that drove the increase in run rate of expenses? Brian Doubles replied, "Thanks for the question. We're investing in employee costs, technology and marketing to drive our health and wellness platform and marketplace. This includes hiring people to develop technology, contracting with tech experts and investing in direct-to-consumer marketing. As a result, we expect to see normalization of operational losses." Brian Wenzel replied, "We have a disciplined approach to our investments, ensuring we get the right return. This is reflected in our top-line growth and operating leverage, which is evident in our efficiency ratios."